Good morning and welcome to this session of the live coaching classes organized by the Board of Studies of the Institute of Chartered Accountants of India. In this series of classes, we've been talking about share capital, and today we will be talking about debentures also. This is possibly the last session for this topic. Therefore, today I will be sharing a PDF of this notes, PowerPoint notes, for your revision purpose, and also as set of assignments, multiple choice questions that you can answer. There was a request, and which is quite fair, for the solutions for the earlier assignments, which I will inshallah put up today, right? So having put this behind us, right, let us get into the topic. Now we have pretty much advanced on share capital. So we saw so many things, right? I hope you will be able to collect them all together and keep it in your mind, right? We went on rights issues, redemption of preference shares, rights issue, right? Transfer and transmission. But that you'll also appreciate one thing, that in the context of dematerialized securities, okay, most of these sections are not relevant for listed companies and those companies, but still sections relating to transfer and transmission of shares still relevant for unlisted companies. And let's not forget that the listed companies are, yes, of course, yes, they've issued and the volume of trading is high, agreed. But having said that, the number wise, they're only a tip of the iceberg. The real number of, there are about, we already saw, I think, about 3 lakh companies. Now, out of this, listed companies would be hardly 80,000, 90,000 actively traded. That maybe my number is wrong. I'm sure there's somebody here who's certified on NSE and all that who will help me out. But whatever it is, the listed company number is the tip of the iceberg. The bulk of companies are unlisted, public, and more private companies. In fact, more private companies get incorporated than public companies in terms of proportion, right? So the point is, most of these sections about physical securities, transfer, etc., apply to unlisted public companies and private companies. So that's still relevant, right? 58, 59 and all still relevant, but then contextually, see, transfer of shares happens once in a while for a private company person. Ownership changes, some within relatives they change it, or a new guy enters and he's allotted shares mostly, rarely do we. Many times I've seen transfer and transmission of shares become relevant in the FDI, that process also. The main thing being Ch-4. So we saw rights issue, we saw bonus issue, right? And then we went on to reduction of capital. Now reduction of capital, you know the procedure. Bottom line, you need a special resolution and a confirmation by tribunal. Remember this. Before giving its confirmation, the tribunal will ensure that there is no objection from these bodies, especially the creditors. So in a reduction exercise, the most affected people are the creditors, because as part of the reduction of capital, you may end up extinguishing or reducing the liability on partly paid shares. That will be a real damage for the creditors, because the uncalled portion of the share is the amount that the creditors can look to for repayment. In fact, it used to be called reserve capital once upon a time, and the company could resolve that it will not be called up except for the purpose of, or in the event of winding up. So that's a protection for the creditors. Now you are saying I'm going to reduce that liability. So it's, in this context, definitely creditors are entitled to have a voice and say, why, hey, we don't want this, or what's the point, or right. So the creditor's interest has to be protected. One of the two pillars. In the case of reduction of capital, the law is very concerned about the creditors, right? There are deposits which are still not paid. Debentures are still yet to be redeemed on the due dates. Financial institutions are yet to receive their repayment. And now you want to repay the capital or pay the capital according to you, which is in excess of wants. Somebody has to tell you, hey boss, no, it's not possible. You'll have to first settle all these fellows. Then Yes, if you got money still left out, please take it. So this is the whole concept. You see, that is the core principle operating in reduction of capital. The creditor's interest should be protected. Either they should be discharged or determined. See, somewhere you should have enter into some sort of an agreement with them. So you can say, boss, I owe you 5 crores. I can't pay you now. Allow me to go for this scheme, right? I'm sure I will do well in future. So I'll pay you in 5 installments. Right, agreed. Something is better than nothing. Instead of fighting and going to court and losing, it's better to at least wait and get the payment over a period of time. Secured. So you give him an asset and say, look at this asset is there for you. We will create a charge. Very shortly, you'll be listening to lectures on charges, registration of charges. When you offer a security of the company you offer an asset belonging to the company as a security for a loan. A charge is created. Agreed. So when that happens, it's becoming a secured loan, which means tomorrow, even if everything goes wrong and this company goes into winding up, this man can sell that asset, take his debt, because he's a secured creditor. So that is also possible. Or at worst case, you go to him, fall at his feet, somehow get his consent and come back. Do something. But without the creditors confirming, consent or no objection, the reduction will not be confirmed. Right? So this is the core principle in reduction of capital. Good. Usually reduction of capital will happen when there is a restructuring, a financial restructuring. See, companies normally should not run at loss. The purpose of running a company, a profitable entity, a commercial entity, is to make money. If you're not making money, I will ask you, why are you doing this? Right? Why are you even bothering? If you're not making money, whatever justification, seriously, I'm not into this theory that companies are there for serving society. That could be a peripheral goal. Later on, when we come to accounts, I will talk about corporate social responsibility. But that cannot be your main objective. Incidentally, you made money. Now you want to share a small portion of that money with the society. Good. Laudable. Salute you. But that cannot be your main purpose. The main purpose of a commercial entity is to make money. Having said that, due to circumstances beyond the control of the promoters or sorry, I cannot accept excuses, please, because some companies may make losses and they may get into financial difficulty. At which point in time, there is a need for some sort of a financial restructuring. Maybe you may want to go to the creditors and ask them to waive off the interest, even waive off a little bit of principal if they are idiots enough to do that. It's a public sector bank and the minister, you can get it done, yeah. It's a matter of signing off on a paper and the MD of that bank will say, chalo, take it off. So, point is this, when you go to the creditors with this type of a request, the creditors will jolly well ask you, hey, okay, we are taking a haircut. What are you going to do? That is when we'll go for reduction of capital. So you'll go back to them and say, look here, shareholders, including the promoters, invested 10 rupees or at the time of incorporation or whatever, even at a premium they might have invested. Today, we are going to wipe it off. We are going to reduce the face value from 10 rupees to 1 rupee or 10 paisa. See, we can't make it 0 because it needs to be there, right? Some token amount should be. So sometimes it will come down to 10 paisa also, no problem, or 1 rupee, and it will be there. So we are also losing, we are also sacrificing. So this will be part of a scheme of arrangement, which will be approved. And there's a different section for that, a different chapter when you come to the final examination, you will talk about it. But at that time, remember, there is a link with 66. There would be a 66 petition also along with that. Why? Because one part of the scheme could be reduction of capital. In fact, when you come there, you will see the section is very clear. 235 or 6, if I remember, 235, yeah. 234, sorry, 232. 232. I'm not very familiar with the section numbers. As I told you, 56 Act, you ask me, I'll tell you. This 13 is not going into my brain. And I'm also not putting in a big effort to remember these sections. Because, hey, come on, I'm 55. I'm not going to write this 57, sorry. I'm not going to write this examination. Yeah, you have to. So why should I bother? It will come naturally. I will remember these sections over a longer period. But for you, You need to remember section numbers and all that. But for me, no. But still, yeah, 232. Point is, there you will talk about reduction again. So remember to link it to 66. I don't know how many of you will remember this words that I told you now, that later on, when you come to final exam, when you are talking about 232, etc., you will have to, you should remember reduction of capital. Under that section also, the tribunal has the power to confirm reduction of capital. When it happens under 232, there is no need for special resolution. That's all. But it's linked. 66 is linked to them. Right? Chalo. So you're happy. I hope any doubts are there, you can ask me now, because today, let's hope that, we will complete our topic. I see a lot of my people are there. Good students are there. I see Mantanjali is here. Hitesh ji is here. Mehman Rafiq Bhai. Poonam. Pooja is here. Nice. Welcome. Pooja is there. Good morning. Pooja PS and Pooja Gupta. Two Poojas are there. Mageshwaran. Welcome, sir. Mahadev Bharadwaj and Mr. Dete and all. Welcome, sir. Welcome. Thank you, and wishing you all a very good morning. Today being Thursday, let us also take a short moment to salute our gurus. Okay. See, Guru Brahma, Guru Vishnu, Guru Devo Maheshwara, Guru Sakshat Parabrahma, Tasmai Sri Gurave Namaha. I remember my Guru, Professor K.S. Anantharaman. Okay. As you might by now know, a great teacher, and I take this opportunity to remember him and invoke his blessings and presence in this virtual class. I'm sure he's here somewhere. Sorry, listening to all this. Chalo. So, there is a prohibition on purchase by a company of its own shares. Right? Now you might ask me, sir, 66 talks about reduction of capital. What is the purpose of 67? Idea is simple. If you want to purchase your own shares, think about it. As students of accounting, think about the consequence. Think about the consequence. When I purchase my own shares, when I'm the company, I purchase my own shares, what happens? I wipe off the liability on the share capital, right? But unless I go for the consequent reduction in capital, it will look very funny, right? There will be a register of members wherein, say for example, 90% of the shares would be held by outsiders, and one of the members of the company would be the company itself holding 10% stake. That is stupid. Because to that extent, there is no asset, there is no liability. Now, I can't pay to myself. Yeah. So in a way, what has happened? I have wiped off the liability. Therefore, they say, if you really look at it, this is not a prohibition. It's only a conditional sanction. What they say, no company shall have the power to purchase its own shares unless the consequent reduction in capital is effected in accordance with this act. That's all they say. So, if you want to purchase your own shares, if you see an opportunity there, do it. But go through the process of 66. Believe me, 66 is a very long-winded process. But you can do it if you want. Okay? Go through the process of 66. For many reasons you might want to purchase. One of the seriously important reasons and logical reasons should be, if you are a listed company and the share market is stupidly valuing your share at a price below its intrinsic value. And I use the word stupidly very, very calculatedly, and I'm not going to apologize. The market can be extremely stupid both ways. So sometimes it's so euphoric that every Tom, Dick or Harry useless company ka share would be overvalued. And it could be so stupid in terms of sometimes when there is some sort of a fear, pandemic, blah, 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 whatever you give it a name. But point is, market needs to correct itself. Therefore, it will stupidly undervalue blue chips or good companies. Even your company, if you see such an undervaluation happening in the market, it makes sense for you to buy your shares. You might want to hold on to this thought as finance professionals, because This is a beautiful financial, shall we say, strategy. So what happens, some companies even it goes below the book value. So here is a company whose shares are traded in the market, rightly or wrongly, below its own intrinsic valuation. I do a DCF valuation. I know my prospects, right? I know what I'm going to do in the next 5 to 10 years. I am the company. I am the board. I am the company secretary. I am the CFO. We know. So we sit and we crunch, the CFO crunch the numbers and says to the board, boss, it looks so beautiful, yeah. This fellow, the market is really idiotic. Our shares are, even if you don't do anything, if you continue to do what you're doing, your price should be 450. But these fellows are now, our share is trading at 300. What nonsense. So, no, Mr. Company Secretary, please try to increase the value. He said, why should I? These guys are, it's an opportunity. Somebody is selling it, he's a fool. Let us buy. That is the time to buy. Okay, let us buy at this price. So, that is when you will want to go for purchase of your own shares, right? So, the law simply says you want to purchase your own shares, no problem. But go through the process of reduction in capital under section 66, right? That's all. So, one single sentence. So, though the word prohibition is used in the section heading, I would humbly submit that there is really no prohibition. You can do it, provided you go through the consequent reduction in capital. And again, remember, 66 says, buyback is an exception. We'll be seeing in the next section. 68, we'll be seeing buyback. Buyback is an exception. Buyback of shares is an exception to the general rule. You can buy back your shares without going through the process of 66. We'll see it very shortly. So whatever it is, there is nothing wrong in a company wanting to purchase its own shares. But if it wants to do that, it should either go through the 66 route or go through the 68 route. Either go for a proper application to the tribunal, confirmation, etc., in which case there is no limit. You can go any amount to any amount. Or you go through the 68 route, which you will see, buyback, where there's a limit on how much you can buy back in one financial year. That's all. This is a different process, and you don't have to go to tribunal if you are going to buy back. That's it. So either way, you have to do that. Similarly, instead of the company buying back its own shares, it may go through another route where it has money. It will give financial assistance to somebody who will buy, sort of even as a binami or a nominee or whatever. That is prohibited. No public company shall give financial assistance for the purpose of or in connection with purchase or subscription of or for shares in the company or its holding company. Either you can't give financial assistance for purchase or subscription of shares in the company or its holding company. Why not subsidiary company? Because I can buy directly. I can purchase the shares of a subsidiary. But again, I can purchase the shares of the holding company. No. Remember, there's another prohibition. A company about cross holdings. Do you remember? Post the 2006, in fact, 56 Act, section 42 was there. A subsidiary cannot purchase shares in its holding company. Only exception, you can hold it as a legal heir or as a legal representative in that capacity, or if you are already holding it on the date of amendment or on the date of passing of the law, those shares are permitted. Already holding, but post the law you cannot. Okay. In fact, post the 1956 section 42 was amended long ago. I forget 80s or so. From that day, you cannot purchase, a subsidiary cannot purchase the shares of its holding company straight away. You can't also give financial assistance for that, whether directly or indirectly. And whether by means of a loan, guarantee, the provision of security, or otherwise. See how they are giving so many words. Loan, I give a direct loan. Guarantee, I give a assurance or a guarantee to Mr. X. X gives a loan to that person to buy my shares, not a loan. Or I give, say, some asset as a security and say, look here, I'm giving you security. On that security basis, you give a loan to this gentleman who will buy my share, whatever it is. In case human beings discover one more method, suddenly they've used the word otherwise. Whenever you find the word otherwise, remember, absolutely there is any other method is covered. Okay, maybe later on when I come to some other topic. I'll talk about more about otherwise. Today, let us not go there. Pooja is asking, I cannot understand how company's capital decreases if it buys its own shares. Think about it. When you purchase your own share, what entry you will pass? What entry you will pass? Huh? Normally, if you purchase the shares of some other company, what entry you will pass? Investments account data to bank. Agreed. Fairly simple. So what happens? Investments comes to your balance sheet on the asset side. To that extent, there is a capital. Agreed. Share capital will not reduce at that point in time. Agreed, madam. Arithmetically, you are right. Arithmetically, on the liability side, I will have 1 crore capital. On the asset side, I will have other assets, and then I will have 20 lakhs worth of own shares. Now, just let's go to reduction and look at this point. When capital may be reduced? When capital is not represented by assets. Now, what is an asset? Asset could be a tangible asset. Asset could be something which has value for me. Asset could be something which will produce income in the future, which is why intellectual property rights technically become assets, because they give me a valuable right, which if exploited can get me a future stream of revenue. Agreed. But under any definition of asset, your own share is not an asset, yeah? Because assuming that it is an amount that you can receive from somebody, who is that somebody? You. You're good. Okay. Something like that. So, I would humbly submit to you, madam, that though arithmetically you are right. The minute I purchase the shares, only investment account will go up in the asset side. Liability will be the same. Arithmetically you are right, but substance over form. In reality, to that extent, the capital is not truly represented by asset. Therefore, the law says wipe off. They will not write back. So obviously, you will debit share capital and credit investment account and close it. That's all. Got it? So thereby, the balance sheet will become clean. It won't look like this. This is the best explanation I can give you, Pooja ji, for your answer. Your basic question is correct, or rather, the way you understood it is not wrong. How companies' capital decrease? It won't decrease. When I purchase, as investment will go up on the asset side, share capital remain the same. But to that extent, the assets are not. The capital is not represented by assets. Same thing with buyback also. When you buy back shares, you have to cancel the shares, and physical shares have to be destroyed. If it is a dematerialized share, it has to be deleted. Thereafter, it cannot be there. This is there in India, right? But there are countries, I'm not able to, I don't know if it's there in US, there are countries where a company can trade in its own shares. And even in India, you can purchase your own debentures and hold them. You can purchase your own debentures and hold them. And at the time of redemption, instead of making payment, you will cancel the debentures against the liability. The investment account debentures, the investment in own debenture, you know all the way. Come on, I'm a fool, I'm an idiot. I'm teaching you people accountants. You, what a crime. You people know what I'm talking about, okay? So, good job. I shouldn't even be doing this. I'm a teacher of law. How can I even presume to teach you accountancy, which I do not know? I confess, I'm not aware of accountancy. I prefer not to be aware of, because every time, I don't mug up entries, I don't mug up concepts and all that. Every time a situation comes to me in my practice, I work it from basics. I look at what the real transaction is, what is the meaning, and then see what the accounting treatment should be. And if necessary, I have even held a view, and I said, this is my view, because I'm a chartered accountant. Okay, we chartered accountants decide what is accounting. Okay, you don't have to obey. We define the rules. That's my belief system, which means you should be more interested in understanding the transaction and the implications for the parties rather than blindly follow some rules. So according to this, according to that, which could be wrong. And sometimes you might create a new situation where you might say, hey, in this situation, this is a better rule, and the institute will jolly well adopt it. That is the beauty of a profession. The body of knowledge, which we call the accounting standards or whatever, is a living body of knowledge. It is not static at all. It is 100% dynamic. I as a member of the institute, and you as a future member, when you become a member, we have the right to inform the institute. This is a situation I have come across in my practice. I feel that in this context, this accounting standard tells me to do this, whereas that would be wrongly representing the real facts. I would humbly suggest that we could give this type of a disclosure. Why not? And if that is acceptable, the Accounting Standard Board will definitely amend the accounting standard. You are entitled as a member to do this. That is the power you will get as a member. Never ever forget that. And behave like, an ordinary person, mucking up and obeying. You have to obey, yes. By and large, obviously, you can't go around valuing stock at market price and all, unless the accounting standard permits and the context permits you to do it. Think about it. This is a broader view. So if you still feel, no, Mr. Srikanth, I'm comfortable either finding fault with other people's views and blindly obeying what they say, I will not disturb your complacency. But think about it. Independent thinking actually helps you. Thinking from first principles is an ancient Greek concept. Okay, and it's difficult, it's boring, it's not worth the effort, but it leads to other advantages in your life which cannot be measured in monetary terms. Yeah, money will come, don't worry about that. Okay, going on. Now I'm talking useless things. But anyway, going on. Thank you, Pooja, for that. Keep the questions coming. You have a doubt, ask. Maybe sometimes I am entitled to be wrong. You are entitled to be wrong. But we are duty bound to learn, grow, and move on. So, being wrong is not a crime. Being right is not a great achievement. Because for a long time, the Catholic Church believed that the earth was the center of the solar system and the sun was revolving around the earth. Who was right, who was wrong? At that time, Copernicus was wrong. Galileo was wrong. The church was right. But later on, you know what happened. Okay, so who is right, who is wrong? There is no right or wrong. We keep on learning. I may be wrong, I will learn. You may be wrong, please learn. Don't waste your time arguing, telling the other, trying to prove the other person is wrong. If it's wrong, on the face of it, you have understood it. It's my humble suggestion. Okay. Now, obviously, we are saying you should not give financial assistance for purchase of own shares, right? Then, exception should be there. Remember, whenever a rule is stated, automatically exceptions will be stated. That is the nature of life. Because for every rule, there will be a few exceptions. These exceptions prove the rule. These exceptions cannot become a rule. But the exceptions show that the rule is valid. Okay. In fact, what I told about thinking from first principles and analyzing and understanding is an exception to the general rule which says, thou shalt obey, do what other people say. The authorities are intelligent. They know everything. Don't question them. That is the rule. It works 95% of the time. And it's good. And I also agree. I also obey. But 5% of the time, it's better to think independently. Especially when it comes to the stock markets, I found that if I follow the crowd, I am a fool. If I think on my own, I make money. Chala. Exceptions. Lending of money by a banking company in the ordinary course of its business means, think about it. I can give you a practice. One of my clients is a HNI, high net worth individual. He's got a huge portfolio. He's banking with a foreign bank. And the bank has a PMS, Portfolio Management Service. Now, what he does is, sometimes he does heavy trading. So, he pledges his shares and he borrows money and buys and sells. And he makes more money that way. That is why he became HNI. The point I'm trying to make is, at one point in time, he may be holding shares of that company. He may be holding shares of that company in his portfolio. When he borrows money to buy more shares, in a way, that banking company is funding him for purchase of its own shares, not allowed. Because it's in the ordinary course of its business, nothing wrong. Okay. You may be having a PMS or you may have borrowed money from State Bank of India for trading in the stock market. Using that money, you might buy State Bank of India share. Agreed. I think this example is easier. Allowed. Exception. Another. Funding of purchase or acquisition of shares to be held by employees or trustees for the benefit of employees. In accordance with a scheme in accordance with the scheme approved by special resolution and the procedures and conditions laid out in Rule 16. Right? So, funding of purchase or acquisition of shares to be held by employees in accordance with the scheme. So you cannot take an individual employee and say, hey, I like you, come take money, buy my share. No, there should be a scheme. See, what could happen is company may go for an ESOPs. Fantastic. You are giving that fellow an opportunity to buy your share, possibly at a price below the market price. Yeah. But your current market price of a share is 2,600 rupees. You are giving him 100 shares. He has to now raise, and you're giving him 1,800 rupees. 100 shares, 1,800. How much? 1,80,000. Not a big amount. But suppose another employee is getting more. Even that 1,80,000 may, see, we are talking about a car driver or somebody. He doesn't have the money. So they will come back to you and say, look here, sir, we want to buy, but the salary you are paying us is not worth even for eating. So how will I buy this share? What is the use of? So the HR department will break its head and say, chalo, we will fund you. You bring 50%, we'll give you 50% of the amount. So a scheme will be approved. And that has to be approved by the members by special resolution. There's a rule 16, which we need not go into. Point is, if you pass a special resolution approving a scheme, then you can lend money to the employees. But again, there is a limit. Funding of purchase or acquisition of shares by persons in the employment of the company, other than directors or key managerial personnel, up to 6 months' salary. So A is banking company, B is scheme, where all employees get a loan as per the scheme and they buy the shares. C is you can target individual employees and you can give them a loan for purchase of your own shares. Persons in the employment of the company, other than directors or key managerial personnel, be careful. We can design one question just out of this point. They can talk about a company going for a public issue and in that process offering shares to its employees, and now they want to give to a particular 5 or 6 employees. There is no scheme. Okay, and there you might say 1 or 2 directors also I will include, and then I will say these are the people and they are getting so much loan. Salary also I'll give. So once I give that salary, you should see if the loan is more than 6 months salary. If it is, then not allowed. Should be less than 6 months. And these employees should not include directors or KMP. KMP definition, I'm sure you studied when you studied the preliminary topic. Yeah, Pooja, I agree with you. Don't worry. Don't worry. Till you finish your final exam, you are a student. And in that process. But I'm sowing the seed of thought in your mind, which I shouldn't have done. Sorry. I take back whatever I said. Blindly follow what teachers say. Don't think for yourself. What do you say? Or think for yourself and argue. Don't go to the basics of the principles involved in the topic. It's a fantastic way of leading a life, no. Understand what the core principles involved are. What are the principles operating here? Then from those first principles, try to understand the topic. Then automatically you will be able to give better answers than a person who blindly follows. This is all I'm trying to say. It's a very, very advanced thought. Sorry if I am overloading you with too many big thoughts. Leave it. What is there? Yeah. Just want to pass the exam. Right. So what is there? Leave it. Okay. Nothing in this section, that is 67, shall affect the right of a company to redeem any preference shares issued by it under this act or under any previous company law. See, the word they are using here is purchase its own shares. They have not said equity shares. Therefore, they give the exception which says, hey, preference shares are exempted. In fact, this is one more exception. You can redeem preference shares. That is not amounting to purchase of its own shares. Right? Because redemption of preference shares is already controlled under a different provision. There, you remember, you can redeem, that is the greatest control. You can redeem preference shares only out of profits or out of fresh issue, so that the permanent capital of the company will not be depleted. So having put that check and balance there, they take it out of 67 and say, go ahead and redeem, subject to redemption provisions. That's all. So in case the company violates this section and gives money for purchase of its own shares, etc., loan, etc., there is a fine of 1 lakh to up to 25 lakhs for the company. For the officer also 1 lakh to 25 lakhs. and imprisonment. In this case, imprisonment is very much there, not removed. Up to 3 years imprisonment. So violation of this section is considered to be a very serious issue. No, because the funds of the company should not be diverted like this, even for purchase of its own shares. See, especially some crooked promoters will do this. They have to increase the promoter's contribution. Instead of doing it from their own money, they will try to take it out of the company as a loan and reinvest. Not possible. Not possible. So if they do it, it's a violation of 67, and straight away any officer in default, including that MD, will go to prison for 3 years. Now we come to the last topic in this, not the last, debentures is the last. In shares up to 71, up to 69, this is the last. So, buyback of securities. Again, remember 66, 67, 68. 66 talks about the general provisions on reduction of capital, confirmation of tribunal, special resolution, etc., etc. Now, obviously, a company may not want to go for an elaborate purchase of its own shares, but may want to seize an opportunity. Buyback of, in fact, there's a bigger argument. Some people will say buyback of securities is used when there is an adverse takeover and all that. Sir, logically, I will buy back only when my share is, when I am the CFO or I am the MD, Director of Finance, and I see that I do a valuation, which I should do frequently. I do a valuation of my business and company. I come out with a figure. According to me, that is the fair market value of my company shares. Okay, this can be done by the CFO. After all, CFO is also a finance professional, right? And I don't need a registered valuer to do it for me. Any chartered accountant who has the knowledge and experience, and more importantly, if you've been the CFO of that company for 10 years, you will not only be an authority on that company's technology and industry, you should be an authority on the industry itself. The entire industry you'll know. What economy you'll know. So factoring all that into account, you will have to, it will be done. Okay. You will see that the value of your share is less than the intrinsic value of the share is less than the market price of the share is less than the intrinsic value. Now, when that is happening, there's an opportunity to buy back. So 68 can be invoked. Therefore, 68 is an enabling section permitting a company to purchase its own shares subject to certain conditions. Okay. First, authorization by articles of association. So buyback should be authorized by the articles of association. A special resolution in general meeting authorizing buyback. Obvious. Now, buyback which is 10% or less of paid up capital plus free reserve may be made with approval by a board resolution passed at a board meeting. So where the buyback is 10% or less of paid up capital plus free reserves, it may be made with approval by a board resolution passed at a board meeting. Up to 10% board resolution is enough. But if it is more than 10%, up to 25% or less of paid up capital and free reserves, then you should pass a special resolution. So the upper limit is 25, up to 10% or less. Board can itself pass the resolution. At a meeting of the board, they have to pass the resolution. Suppose you want to go beyond 10 up to 25, you have to get a special resolution passed by the company authorizing the buyback. Once the buyback is over, the debt to equity ratio, the debt is to equity ratio should not exceed 2:1. Again, do you see the protection of the creditors here? Because post buyback, what will happen? My paid up capital will come down, sir. Obviously. Again, same logic of reduction. I can't show those shares as assets on the balance sheet. So I'll have to remove them. That can be done only by debiting share capital. So share capital account debtor to bank. If I'm buying back, that direct entry also I can pass. Or share capital account debtor to investment in own shares. You operate one account if you want. Capture all the own shares in a single account and one fine morning cancel it. Either way, my liability side, my equity is going to go down. Debt will obviously, the proportion of debt will go up. This will prejudice the interest of the creditors. Therefore, the law says, go ahead with the buyback, but post buyback, the debt to equity ratio should not exceed 2:1. You should buy back in such a way that post buyback, share capital and free reserves on a total of equity should be at least your debt should not be more than 2 times the post issue equity, which is paid up capital and free reserves, including preference shares. Preference shares, equity, paid up preference, paid up equity, free reserves. When I total up everything, the total amount, when I multiply it by 2, the debt should not be more than that. Okay. Again, this is a protection for the creditors. But CG may, by order, prescribe higher ratio for any class or classes of companies. For example, infrastructure companies will be highly debt oriented. So, for them, the higher debt ratio may be prescribed. As of now, not prescribed. As of now, it can be prescribed. Shares for buyback should be fully paid up. Very important. If you want to buy back shares, they should be fully paid up. Partly paid shares cannot be bought back. Buyback of shares of listed companies to be as per SEBI guidelines. See, the main thrust of SEBI guideline, if you notice, the procedural part is almost the same. But the one thing that they will give you is an elaborate guideline on how the value should be arrived at for the buyback. Valuation or the purchase price of the buyback. You know, when you're buying back, what price you should offer is, again, pricing. See, remember, when you issue shares, you're selling. When you're buying back, you're buying. Both cases, you should know how to predict the market trend and provide a price. Buyback of shares by unlisted public companies and private companies will be governed by Rule 17. Very, very important. Offer of buyback not to be made within 1 year of closure of preceding buyback. So, you can have only one buyback in a year. So, if you made a buyback now, then for the next 1 year, you cannot go for another buyback. So, buyback is an annual feature. In fact, many companies, when they see the market swings, use an opportunity to say once in 3 years they may do a buyback to buy. But then, let's see whether you may want to buy back, but the shareholder should be willing to give, right? Let's see one example of what happened in one case. Where can you use, which money can be used for buyback? Free reserves are available. See, just go back to redemption of preference shares. What did we say there? If you want to buy back, if you want to redeem your preference shares, you can do it only out of profits, which means P&L account and accumulated reserves, free reserves, or the proceeds of a fresh issue. Same logic here also. If you want to buy back equity, it can be done only out of profits, means free reserves, which are available in the balance sheet. The proceeds of the issue of any shares or other specified securities, including debentures, etc. Whatever. The one extra guy here is securities premium account. For redemption of preference shares, you cannot use securities premium account. But for buyback, you can use the securities premium account. Okay. Now, no buyback of any kind of shares or other specified security shall be made out of the proceeds of an earlier issue of the same kind of shares or same kind of other specified securities. So, you cannot issue equity shares and buy back equity shares. If you want to buy back equity, you have to issue preference or debentures. And using that proceeds, you have to buy back your equity. Agreed. So, buyback can be done only out of issue of preference or debentures if it's equity. Right. Now, just like, from whom can I buy it back? From the existing shareholders or security holders on a proportionate basis. This is called a tender route. You might have recently many buybacks have come. TCS came out with the buyback. Many companies have come out with the buyback. And so what they will do is, just like rights issue, you issue shares on proportionate basis. For every say 15 shares, you will be getting 1 right share or 2 right shares, whatever. Same way you will say, anybody who is holding 20 shares in my company, I will buy back 2. Whatever. Provided the proportion should not be more than 25%. See, technically, you cannot buy back more than 25% of your paid-up capital. You cannot buy back more than 25% of your paid-up capital. Because there's a limit, right? If you can use only 25% of your paid-up capital and free reserves of buying back, the equity bought back, face value, in terms of face value, you cannot buy back more than 25%. So to that proportion, you can say, anybody comes, I'll take. Proportionately. So if you're willing, give, I'll take. So if you're holding 100 shares, you can tender. It's called tendering. The shareholder will tender the share. He can offer more also. If the shareholder wants, he can offer more shares also. If you want, you can buy. But you can only do it proportionately. And whatever it is, you cannot buy back more than 25% of the paid up capital. Don't forget that. Okay, see, actually there are 3 conditions. You cannot buy back more than 25% of the paid up capital. Further restricted to 25, and of course, 25% of paid up capital and free reserves is the money available for buying back. But you can buy back only 25% of the paid up capital in terms of shares. Suppose the company has 10 lakh shares, you can buy back only 25%, 250,000. Now to buy back those 250,000 shares, you cannot get it at face value, boss. It's a listed company or even an unlisted company valuation. So you have to pay more. Therefore, they say you can utilize free reserves, securities premium, whatever it is. So if you are buying back 250,000 shares, you cannot buy more than that. For that, you have to pay in the market, let us say 30 rupees per share. Then 250,000 into 30, right? So how much? 75 lakhs. Now, you should have sufficient reserves, premium, etc., or proceeds of issue to buy back that money. So, further restricted to 75. You might have more reserves. 25% of your free paid up capital and free reserves may be more than that. But still, you cannot buy back more than 250,000 shares. Right? Got it? Lastly, you have to ensure that the debt equity ratio. See, post buyback, the debt equity ratio may go beyond 2. Debt may go beyond 2 times equity. If so, then that also is to be controlled. There are basically 3 restrictions here for buyback, which you have to go through. Somebody was talking about problems. I'll try to take out a problem and show you now if possible. Okay. Yeah. There's a question on when will we solve questions. I don't know. Timing is a big problem. I don't have time. That's why I'm giving you assignments. Please work out the assignment. I'll send the solution also. Go through it. And if you want, you can. Because the theory content is so high, very difficult. Please go through the questions I'm sending you. If you have any doubts, please raise it during the session. Okay. I'll try to pull up one problem that I have. Let's see. During the break, I'll try to pull it up and share it with you. Buyback. So you can buy it from the existing shareholders, or you can make an open offer for say 7 days. The offer is open. Anybody can come and offer it in the open market. So you will authorize your brokers. A chain of brokers would be hired who will be constantly looking for people offering. So there will be a link that you will send to all your shareholders and tell them, hey, we are opening up. If you are interested, you can come on the open market and tender. So all you need to do is instruct your broker to tender it. That's all. Company can take it. Okay, that's open market. Normally, people don't use that method. They prefer to use the tender route. Then they have brokers who buy within that. It's also possible for tendering through your broker. Today, most companies having their own website. You just go there, click, you get the screen, you keep putting everything in, submit, then their send back a mail to you. It's direct. By purchasing the securities issued to employees of the company pursuant to a scheme of stock option or sweat equity. See, both sweat equity shares and ESOPs can have a buyback option. See, I'm asking you, you are an employee, I'm giving you the share, you are hoping that the market price will go up. But it may not. Company may not do well. In which case, the company itself can say, don't worry. If the market price goes down also, I will buy back the shares 3 years later, or you can offer it back to me at this price. At the time of issue of ESOPs or sweat equity, you can tell them, don't worry. If there is any issue, we will buy back. Okay. Right. Buyback should be completed within 1 year from the date of passing of the special resolution or the board resolution. Right. So 1 year time is given. Shares or securities so bought back shall be extinguished and physically destroyed within 7 days of last day of completion of buyback. With that, see, not only will you pass an entry in your book, share capital, debit, credit, investment in own shares, on that day, you should also physically destroy. If it's a physical, extinguish means delete it from the records and note it. This should be done within 7 days of the last day of buyback. Therefore, SEBI also. One important point is when this destruction is happening or extinction is happening now, they take a certificate from the auditor. Everywhere you have to be physically present at the statutory auditors or his or her qualified representative should be present at the event destruction. With their own eyes, they should see it and certify it. Company not to make further issue of securities of same kind within 6 months. Cooling period. You cannot buy back and then again issue. So there is a cooling period of 6 months when you cannot issue further issue of the same kind, securities of same kind. They use securities of same kind, though we deal with equity here, but to distinguish between normal equity shares and equity shares having differential voting rights. Exception is bonus issue. You can always go for a bonus issue within 6 months. Conversion of preference shares or debentures. When there is an already, at the time of issue of preference shares or debentures, you told them that you will convert. And in discharge of that subsisting obligation, then if you're going to convert, no problem. Or if a warrant is supposed to be converted into a stock share, see, a warrant is a bearer document. When I issue warrants, the person's name will not be mentioned in my register of members. Nobody will know who is the owner of the warrant. He will be entitled to dividend alone, which we will post dividend warrants. Okay, he can collect it from whoever has the dividend warrant can collect it. They can come claim the dividend. Once the company declares dividend, they will claim. So if you prove that you are the owner of the warrant, I will give you the dividend warrant. You deposit and take it. It's called warrants. Again, share warrant is possible under the Companies Act, but to my knowledge, no company has issued. And that too in the context of money laundering and in the context of tax evasion in this country, 100% the scheme will not be approved by the government because people holding it need not disclose their name. See, one of the greatest advantage of Bitcoins today is you need not disclose your name. Every time it will emerge back into, recognition is when in your bank from the coin exchange. That is when somebody will know that you had a Bitcoin trading. Otherwise, the normal banking channels will never come. You'll be holding it in the records, and you will be using it. Wherever you use it, that guy will take it and go close. There's no PAN, there's no Aadhaar, nothing. Nobody knows what to do. So that way, this is a wonderful way of holding. So Bitcoins are there, but warrants equally now. Name will not be known. Simply you transfer it by giving possession. No need for transfer and all that, form and all that for warrants, right? Not popular, not allowed. So don't worry about warrants. Of course, there could be stock option schemes where employees are not given the share, but given an option to buy the share. So in exercise of that option, if he says allot the share, you can. Similarly for certificate also. So these are exceptions to the general rule that a company should not make further issue of securities of the same kind within 6 months. Basic procedure, as we already saw, a special resolution or a board resolution. Also, a declaration of solvency in Form SH9 signed by at least 2 directors, one of whom shall be the MD. Idea is simple. An insolvent company should not reduce its liability by buying back its shares or, sort of giving money back to the shareholders when creditors cannot be paid. An insolvent company means the liabilities are more than the assets. Such a company should not quietly put money in the shareholders' pocket through buyback route. Therefore, they say, before you want to go for a buyback, please give a declaration of solvency. Similarly, the register of shares or securities bought back should be maintained in Form SH10. Giving details of, share, who is the person, all that stuff. It's pure, shall we say, clerical routine work. After completion of buyback, a return is to be filed in Form SH11 with ROC or SEBI. As we said, the declaration of solvency is to be filed by an affidavit to the effect that the board has made a full inquiry into the affairs of the company, as a result of which they have formed an opinion that it is capable of meeting its liabilities and will not be rendered insolvent within a period of 1 year of the date of declaration adopted by the board. So, they are saying for 1 year we will be solvent. Don't worry, if they give a false declaration, they will be put in prison. Yeah. Mantanjali, I see a question. I'll come to the questions later. I'll finish the topic. When you are passing a special resolution, later on when you come to management and administration, I'll tell you about it. You should, every time you want to pass a special resolution, the notice calling the meeting should specify that the resolution is to be passed as a special resolution. And along with that, some information also should be given. Explanatory statement is to be enclosed. And that too, whenever you are, when it's a special business, then you have to give an explanatory statement. Ordinary business, no need. We'll come to that inshallah, on Saturday, we'll talk about it. So when you're giving it's a special business, not normally done, like appointment of auditors, approval of accounts, etc. at an AGM. Everything else is special business. In those cases, you have to give an explanatory statement. The idea is simple. Out of the blue, you send him a resolution, pass it. How will he understand? It's a common man like me who doesn't know company law, okay, not experts like you. So I don't understand here. You tell me context. So you should make a full and complete disclosure of all the material facts. You should tell them our company is doing well. We find that there is an opportunity for buyback. We would like to return some of the money back to you. Now I got the point. So you're giving me back my money. Good. Okay. For which we want you to consent to the buyback by passing this special resolution. Thereafter, we'll send a personal offer to all of you, which you can accept or leave as. Why there's a buyback? You can say, company is having some surplus funds. We want to go for a buyback obviously you won't tell him, hey, you Bakra, the share is quoting below my intrinsic value. So it's better I buy back the share from you. You won't tell him that. You will tell him company is having excess funds and it would like to give back some amount to the shareholders as a gesture. So the class of shares or securities intended to be purchased under the buyback, the amount to be invested under the buyback, the time limit for completion of buyback. All this should be given as an explanatory statement along with the notice calling the meeting for passing the special resolution. Just like for redemption of preference shares, here also you have to compulsorily transfer a sum equal to the nominal value of the shares purchased to CRR account, Capital Redemption Reserve account, and details of such transfer shall be disclosed in the balance sheet. You know very well CRR cannot be used for declaring dividend, but it can be used for issuing bonus shares. So this CRR also available. capital redemption reserve also, and for buyback also available. A company cannot buy back its own shares directly or indirectly through subsidiaries or investment companies, either directly or indirectly through a subsidiary company or another investment company where I'm having a stake, where I invest into that investment company and that company. No. So in all cases, you cannot do that in any way. If there is a default, obviously in repayment of deposits or interest, redemption of debentures or preference shares, payment of dividend to any shareholder. Dividend once declared, it has to be paid. There's a strict rule. You'll see that when you come to topic on dividend, or maybe you've studied it already, where there's a strict rule, 30 days, 7 days, transfer to a separate account, 7 years, transfer to IEPF. Pakka procedure is there. If you don't comply with it, because it's not your money, it's belonging to them. But still, if there's a default in payment, sorry, you cannot go for buyback. See, non-repayment of deposits, debentures redemption, payment of dividend, there are penal consequences in those sections. In addition to that, you will find a company which is defaulting these things cannot do many things in the Companies Act, like buyback, it cannot do, issue of differential voting right shares, it cannot do. So there are other problems if you don't do this. Later on in final, you will see that you cannot give a loan, you cannot make intercorporate investments if you are not repaid deposits. You cannot invest in another body corporate if you are not repaid your own deposits. So many conditions are there if you don't. So which is why it's better to repay deposits and interest on due date, better to redeem debentures or preference shares on due date, pay the dividend once declared. Don't play games with that. Similarly, repayment of any term loan or interest thereon to financial institutions. Right? Where default is remedied, buyback may be made after a lapse of 3 years. So even if the default is remedied, you can't buy back for 3 years. Wait and watch period. 3 years, you are okay, chalo then. 3 years later, you are free to do it. Company is prohibited from buying back its own shares, etc., etc. If there is a default in filing annual report and financial statements, that is also there. And as I already mentioned, there are certain strict conditions on declaration of dividend and distribution, including transfer to a separate account on 7th day and transfer to IEPF and all. If you violate that also, you cannot go for buyback. So there is section 70 deals with buyback, prohibition on buyback. 69 talks about transfer of to CRR. 70. If there is any penalty for non-compliance with 68, then fine 1 lakh to 3 lakhs for company, 1 lakh to 3 lakh for officer. But there was a punishment by way of imprisonment which has been removed, has been deleted by the Companies Amendment Act. So there is no punishment by way of imprisonment. I have not taken it out of the slide. Instead, I have given you the information here. Just for waste your time again explaining all that. Okay. So according to me, a company will buy back shares only if the intrinsic value is more than the market price. Or if you are able to sell your share at a price above its intrinsic value, buy your share back, okay, at a price below the intrinsic value, you are smart. Even an unlisted company, suppose one of the promoters wants to exit, the other promoter will be smart. He need not purchase. He can say, come on, I don't have money, we will buy back. But we can decide. And the company's funds can be used to reduce the liability so that this fellow goes out. I am now the owner. Straight away, without putting any of my own money, I am using. But in all cases, the logic is to be when there is. But suppose it's between two promoters, you can use the buyback route also. Even if the valuation is more than the intrinsic value, chalo, I'm giving him a small premium over the intrinsic value. Why? To get him out. Because that premium I'm giving for control on this entire company, I give a premium. Whatever. Buyback can be used. But again and again, you notice, my dear friends, as prudent future chartered accountants, that buyback and valuation are closely linked. Unless you are doing a proper valuation of your business, buyback may become disastrous. Look at these stories. TCS announced India's biggest buyback 16,000 crore shares via the tender route in 2018. Reliance Industries again came out with the 10,440 crore buyback. TCS buyback was pretty successful. In fact, you will notice every year, including Ratan Tata, every year they are doing it. Why? Actually, there's a different question. Let me throw it. Why is TCS is coming out with buyback offers regularly? Every year they're coming out with a reasonable buyback offer so that the shareholder will be tempted to come. But actually, the target is not the ordinary shareholder like me. The purpose of their buyback is slightly more complicated. Why they are doing it? If you're intelligent enough, you will know why they are doing it. Right? But actually, you should not give that share. Even now it's undervalued. Today it's undervalued share. It will go up. So today, whatever may be the price they're giving, but I saw a good price there. Point is this, buyback. Think about it. Reliance wanted to buy back its own shares. Okay. But only 38% of the offer was accepted. Means the remaining people refused to give back the shares. The stock gained 8% during the buyback. As the buyback is going on, the price is going up. Yeah. Okay. Of course, the reasons are obvious, right? There's a huge appetite for Reliance. Only absolute idiot will give his Reliance shares to Ambani. If you have Reliance shares, you will hold it. You will not give it back. Nobody will. Buyback of Reliance will fail because it's whatever valuation you put, it will be not worth to give it back here. Okay. Even if he offers you something more than the market price, I would still not give because that price will be attained in a matter of during the buyback itself, that price will be attained. So the failure in buyback is actually a sign of prosperity. When a company share, nobody offers it on a buyback tender, the company should be proud. See, we are so financially strong. There is so much confidence in the investor in my share that when I go for a buyback, it bombs. Okay? Think about it. It's a kind of a reverse praise. So every time you need not succeed. Sometimes failing is good. Reliance failing in the buyback is actually showing that the good. But of course, it's a failure for the management because they thought they will buy back and reduce the liability. But shareholders are smarter. They said, sorry, sir, no. We'll hold on to our shares, please. And we know it will go up further. Okay. Sure, Rekha, I'm planning to do that. I'm planning to do that. What I will do, I will give a small break now. And during the break, I will pull up that question. I have a question, the way you are telling. I have one. I will try to do it. Okay. So with this, I'm going to debentures. Debentures, we can finish it. No problem. No, I see a lot of need for numerical here. I also agree. So Mantanjali, let's start with these questions. Hey, Mr. Shashwat Singhai, offline. You locate my mobile number or locate my email ID somehow in an era of internet, social media, blah blah. You will be able to get hold of it offline, not during this forum. In this forum, not fair. I can answer one part of your question. Sir, do you have a CA firm? Yes, I have. It's called Karpagam, Krishnan and Natarajan. Karpagam, Krishnan and Natarajan. We are a Chennai-based mid-size firm. We are not Ernst & Young. We are not PricewaterhouseCoopers. We are not. So why? Okay, think about it. Go to PricewaterhouseCoopers, Ernst & Young. Okay, we are an ordinary mid-size firm. Don't come to us. We are useless. Please explain buyback meaning. When the company purchases its own shares, it is called buyback. See, you saw purchase by a company of its own shares. Now, it's like redemption of share. When you redeem preference share capital, what do? You purchase. In the same way, you are redeeming your equity shares. If you are able to understand it that way. Though we don't use the word redemption, we use the word purchase. You are able to understand redemption of preference shares. Now, what you are doing? You're calling the preference shareholders. How much do I owe you? Take the money. Give me back the certificate. Tear it and throw it. So that to that extent, my liability will be extinguished. I don't have to pay him now. See, think about it. Even the share capital is a liability. At the time of winding up, I have to pay him. When I buy back, I extinguish that liability. That is what buyback means. I think Ayushi Shukla has a lot of doubts. No problem. We'll give a numerical problem. Yes, we will give one numerical example. I will do it. I agree with you. Share warrant, I have already explained to you. More than enough I have explained. And it is not relevant at all. I think I hope you listened to me when I spoke about share warrants. I did mention it. I did talk about it. So listen carefully. Don't worry, just listen. Mantanjali keeps putting up statements. So what does she want me to do? She wants me to give an answer or just read out a statement? Because you are right. You are saying, yes, sir, CRR used only for bonus issue. What are you doing here, Mantanjali? Are you confirming that I am right or what are you doing here? I mean, sometimes you do this. I love you for doing it. I have nothing against what you are doing, but tell me, what should I do with those comments? Thank you, or whatever you want. Okay, no problem. But I mean, if you have understood it, I am very happy. Thank you. So many times I see comments, yes, sir, CRR used only for bonus issue. You are correct, sir. Thank you. Already there's a section saying generally a subsidiary cannot hold it. How can they directly undertake buyback? That's exactly the point. Okay, that's why here subsidiary is not covered. Subsidiary cannot, you cannot purchase the shares of a subsidiary cannot purchase the shares of its holding company. It cannot be done. But this is a holding company can have subsidiaries, right? Now, through the subsidiary, okay, it can, the subsidiary cannot buy, but I can finance the purchase of shares of a subsidiary, right? No public company shall give financial assistance for the purpose of in connection to purchase of shares in the company or its holding company. That's why subsidiary is not governed here. Subsidiary is not good. One more thing, if I want to purchase shares in my subsidiary, why should I bother? I can directly buy my shares in my subsidiary. Absolutely no problem. What I'm not supposed to do is, I'm not supposed to finance the purchase of shares in myself or in my holding company. Subsidiary, no problem. Why will I even finance somebody to buy? I will buy directly in that company, right? So, that is the point. So, subsidiary cannot buy shares of its holding company. No. Okay. Nor can it give financial assistance for the purpose of purchase of shares in its holding company. Here we are talking about financial assistance. In the other section, directly purchasing was covered. Subsidiary cannot directly invest in its holding company. Here they say you cannot give financial assistance. Again, remember, public company, that seems to be an important point here. No public company. Private companies can. Can a company buy back its shares from the employees who leave the company? They can, but only one single employee. You want to go through 68 procedure for one employee? I don't think it's a good idea. What you will do is you will ask, the promoters will buy it back. That is easier. Buy it from him. Why the company should buy back? If it's just one employee leaving and he's holding some shares, we'll buy it back from him. But if it's substantial, that one employee is a key employee and he's holding, say, 5% of the shares of the company and you want to use the buyback route, you can, provided you go through 68 pass a special resolution and all that. Or if it is less than 10%, board resolution process. You can use the buyback route. Yeah, Mukta also wanted some other explanation, right? Point C under buyback of securities, section 68. Point C. Let us see. Is this that point C? Proceeds of the issue of any shares. See, you are not having enough profits to buy back. You are not having securities premium account also. Then how will you fund the buyback? Where the money will come from? You have to issue a fresh issue of securities, and using the proceeds means the money raised from that issue, you buy back your shares. So funding of the buyback. That is this C. This C is purchasing securities to employees. See, you're making an ESOP. At the time you're asking him, you buy my share at 1,300, market price 1,800. Good. If it's 1,800, he makes money. But suppose the price comes down to 1,200, whatever, the company will say, don't worry. Whatever happens, I will buy back your share after 3 years at 1,600 rupees. So, employee has confidence, or a sweat equity allotee has confidence. Why buyback required by company? I have given the answer here. That's what I'm giving again and again. If you're not able to understand it, think a little more, you'll understand. The company has an intrinsic valuation based on discounted cash flow or whichever model you're using. If you use multiple methods in a boom market, you will never find your share is undervalued. It will always be valued correctly or overvalued. You will think, but if you go for discounted cash flow, you will see intrinsic valuations are there. And your intrinsic value will be more than the market. When the market is actually undervaluing you. Okay, is the point. At which point in time you can buy back. If you're not able to understand, you leave it. Generally, textbooks will say buyback is there only for at the time of adverse takeover, like that. Adverse takeover buyback cannot help you. Can't help you to go, but don't worry about that. Some textbooks will put adverse buyback of shares is useful when there is an adverse takeover. I don't know how it will help in an adverse takeover because somebody else is trying to purchase your shares from the shareholders. Company also goes for a buyback, but you can go only for 25%. He has no limit. He can go up to 40% also. So how you will compete with him? In other words, the company, when the adverse takeover bidder makes an offer, the company also makes an offer to its existing shareholders to buy back. So competing with that. So that's one more reason why buybacks are used according to some textbooks. Maybe it was used once in a while, but they're stupid because the guy will get into a bid war with an adverse takeover bidder. That's not the way you should do it. That's not the way you should do it. The battle has to be fought in court. Hire the best lawyers, go to court, get a stay. That is the only way. Show to the tribunal or the court that this guy, if he acquires my shares, the company will be mismanaged. And so to protect the company, please stay. That is the best way to get out of an adverse takeover in a legal route. And let the court decide what happens. So, can I convert equity shares into loan? No, sir. Not possible. Not possible. Equity shares cannot be. Never have I thought about it. Good question, but as of now, I don't see how equity shares can be converted. Conversion is possible. Debentures can be converted into equity shares. Loan can be converted to equity shares. Equity shares, it's a capital boss. Once in. Maximum what you can do, you can buy back. That's all. You cannot convert it into. Good question. Asked by a student who is still learning the subject, but please understand. This way it's not possible. The firm which you told now is could be. Notice during buyback is given to whom? Equity share, the existing shareholders, the people who are owning shares in the company, only they will get through email. See, the members list is there, na? Through that they will. But for passing the special resolution, every shareholder will get offer. If it is there are two ways of doing it now. Suppose you are using this route, proportionate tender route, you will send it to all the shareholders by email, give them a time period. If it is open market, you will simply make a public announcement, maybe even send a mail to shareholders saying, boss, we are buying up to this limit, we are buying. First come, first served. If you want, come and give. I will take it. That is also possible. Beautiful. Intrinsic valuation means the fair market value. Maybe I don't know if you've been taught valuation. When you come to final, you'll definitely learn. So we find out the future prospects, monetize it, and then don't worry, it's very complicated. It is not the actual, I don't know what you mean by actual value, and I don't know prevailing market value. No, that is what I'm trying to compare with. I'm trying to see what is the real value of my company by some methods. which if you have not been taught, don't worry. As a future chartered accountant, you would be an expert in that. You should become an expert in valuation. You are the only expert in valuation. If you become a chartered accountant, you are automatically an expert in valuation. Should be. So you'll be taught. Don't worry at that time. But as of now, all I'm trying to say is the company could have an intrinsic valuation based on its future prospects. The market, it's a demand and supply. Sometimes it could undervalue the share. It happens regularly. So, anyway, if you want to know more about it, please look up intrinsic valuation on the net. It's a lot of information. Read a book by Mr. Ashwath Damodaran on valuation. There he talks in detail about intrinsic valuation. Wonderful. The time now is 8:21. Let me announce a small, break, right? Okay, for 10 minutes. So 8:22 means around 8:32, we will recommence the class. Welcome back from your well-deserved break. So as some people are asking for some practical problems, multiple choice may, here we go with some ideas. So paid up equity share capital of ABC Limited. No, this is not going up. Is 50 lakhs. Face value of 10 rupees each, fully paid up. Other details, general reserve 15 lakhs, capital redemption reserve 4 lakhs, already there. P&L account 1 lakh, statutory reserve 6 lakhs 40, securities premium 1 lakh. Board of Directors passed resolution in board meeting to buy back maximum number of shares as allowed by law. What is the maximum number of shares that can be bought back? 10 rupees face value, assuming we are buying back at 10 rupees. See, the clue here is that board of directors. So it's 10%, right? So you can buy back up to 10% of paid up capital free reserves. While calculating free reserves, we take general reserve. CRR is not included. Statutory reserve not included because it is not a free reserve. It is created in compliance with some statute, right? Some statutory purpose is there. Like SEZ reinvestment reserve meant for some purpose, so not taken. Securities premium account is taken, P&L account is taken. Right? CRR and statutory reserve not possible to use for buyback. So you calculate 10% of this amount, I get 6 lakh 70. 6 lakh 70 divided by 10, you can buy back 67,000. Okay. Securities premium can be used for buyback. Now, somebody wanted me to explain prohibition. Bharat, I will do that. Quickly, I will do that, but it's too elaborate. Don't ask me to do it fully. I will explain to you what it is, then you will understand. Prohibition. I'm not going to waste your time. There is one more. See, this is what I want to really. I don't know why this thing is not going out. We'll actually follow this thing. The following information is available from the balance sheet of TH Limited. Equity capital is 30,000, 3,000 lakh shares of rupees 10 each. 3,000 lakh shares of rupees 10 each. Everything is in rupees lakhs, so don't bother, it doesn't matter. So 30,000 lakhs is the equity share capital divided into 3,000 lakh shares of rupees 10 each. General reserve 10,000 lakhs, secured loans are 40,000 lakhs, unsecured loans are 22,000 lakhs. What is the maximum limit up to which buyback is permitted in the financial year 18-19? Now, here we will be seeing it. See, some of you have gone for 25%. No, because the board wants to do it. That's why it's 10%. And at 10%, you can buy back during the year. Up to 25% of paid up capital, you can buy back. Okay. So within that limit, you can buy back. That is the real point in this first one. That's why I gave you that. But here you are going to see a totally different thing. What is the maximum limit up to which buyback is permitted? That means if you are going to go for shareholder approval, Right. Now there are three conditions to be satisfied. Am I correct? Three conditions to be satisfied. Let us see if somebody comes out with an answer for this so that I can take it up. Actually, 55,000 looks tempting, but it is not, because you can buy back up to 25% of your paid up capital and free reserves. That means paid up capital. Right. Up to 10% of the paid up capital and free reserves can be done by the board. But once you want to go to the shareholders, it's 25% of everything, paid up capital. Ms. Mukta, please don't put so many question marks. Why so many question marks? Okay, let us see the solution or whatever it is. Mohammed Farad has got the answer right, but he got it right by a very, very peculiar arithmetic. Because the value of a share is 10 rupees. Okay. See, first rule, the buyback of equity shares in any financial year should not exceed 25% of its outstanding equity shares in that financial year. So you have 3,000 lakh shares. That means you cannot buy back more than 25% of 3,000 lakh. You cannot. So you cannot go beyond 750 lakh shares. Though, if you consider the free reserves also, 10,000 free reserves is there now. General reserve 10,000 can be considered. Then you have 40,000 lakhs. On that, 25% is 1,000 lakh shares. Okay, 1,000 lakh shares. Now, 25% of this. Okay, 1,000 lakh shares. But it is restricted to further 750 because you cannot go beyond 40,000 lakhs into 25% divided by 10. So in terms of shares, it comes to 1,000 lakh shares. Or you can say 10,000 lakh rupees, 1,000 lakh shares. So between 1 and 2, you are restricting it to 750 because you cannot buy more than 25% of the paid up outstanding equity shares. By that logic. Though because of your reserves, you are able to, the amount you can use. See, if you are buying back at a premium, the 250 lakh is available to you. But you cannot buy back more than 750 lakh shares. The price you pay, now it may be more. In which case that extra premium will come out of this extra that money that you got. To put it very bluntly, you can buy back only 750 lakh shares, but you can spend 10,000 lakh rupees for that. You can buy back only 750 lakh shares, which is 25% of your paid up capital, but the amount you can spend, for the buyback can go up to 25% of 40,000 lakhs. That is paid up capital and free reserves. 10,000 lakh rupees can be spent. But in terms of shares, because in terms of shares, you cannot go beyond, at this point, 750 lakhs. Now you got a further condition. The ratio of the aggregate of secured and unsecured debts owed by the company after buyback should be not more than twice the paid up capital and its free reserves. The debt to equity ratio should be 2:1. So the debt to equity is 62,000. Am I correct? 40 plus 22, 62. Secured plus unsecured debt. Both are to be taken. Liabilities are to be taken. Debt to equity. Divided by paid up capital and free reserves. Now think about it. We are assuming the buyback number of shares amount, rather the amount of buyback to be X. Now once I buy back X, what will happen? I will pass the entry share capital account debtor to bank. So to that extent, my paid up capital will go down. Since once I buy back, in fact, this question was asked by Akash Neil. It says, does buyback reduce outstanding shares? Yes, it does. Because once I buy back, I will pass the entry share capital account debtor to bank. So that share capital will be debited. To that extent, paid up capital will come down. It has to be done. I can't show this as an investment there. Also, I will transfer my free reserves to CRR. To that extent, my free reserves also will be reduced by the amount of buyback. If I am funding it entirely through profit. Suppose I am making some other issue, then to that extent, no problem. To the extent that it is funded by profit or free reserves, to that extent, I will reduce my free reserves by transferring it to CRR. So to the extent of the buyback amount, which is X, my paid up capital will come down, my free reserve also will come down. Got it? Now post issue, the balance sheet will still have 10,000 again, but it will have moved from free reserve to non-free reserve. It will have moved from general reserve to capital redemption reserve. So the balance sheet will still have 10,000 number, but in classification, it is no longer free reserve. My free reserve will come down. So while calculating debt to equity, to that extent, it will come down. So 62,000 by 40,000 minus 2x. When I open the brackets, minus 2x. Solving the equation, we get 4,500. So 4,500 lakhs per share, 10 rupees. That's why you got 450. 450 lakh shares can be bought back subject to all the three. Because if you buy more than 450 lakh, you will violate the debt to equity condition. Okay. So I have given you the best explanation possible. You might have a challenge in understanding how 750 and 1000 are coming. 750 is 25% of paid up outstanding equity shares. This is the limit. The money that can be used can go up to 10 lakh, but in terms of shares, you cannot buy 1000 lakh shares. You cannot buy 1000 lakh shares. You can buy only 750 lakh shares. But to buy that 750 lakh shares, you can use 10,000 lakhs. No problem. Extra premium may be paid beyond the face value. For that purpose, you can use. Which is why they are giving you 25% of paid up capital and free reserves. Because you need money, funding. The funding can come out of the reserves. Suppose that is not sufficient, but you still want to buy back. You can buy back 750 lakh shares, but your equity capital and free reserves only 10,000 lakh shares. Suppose together with premium, this 750 lakhs comes to say 15,000 lakhs. Then the remaining amount should come out of further issue. Now this 750 lakh is further reduced because of equity, because of debt equity ratio. And your free reserves is going down. So debt equity ratio is going down, is the point, right? Good. This is one practical problem I thought I will answer. Let's also quickly do prohibition because somebody wanted me to talk about it. See, there is a prohibition on going for buyback in there. Whenever the company is not paying its debentures, redeeming its debentures or repayment of capital, any of these conditions, non-payment of dividend, non-repayment of term loan, etc., then such a company cannot go for buyback. Where there is a default, such a company cannot go for buyback. In case the default is remedied, means I pay back the deposits or I redeem the debentures also, I cannot go for buyback. I cannot make a buyback of my shares for the next 3 years. Only after 3 years I can do it. This is one type of default. Another type is where you have not filed this is not default, this is non-compliance. This is default, this is non-compliance. You have not filed the annual return, you have not filed a financial statement, then to that extent you cannot go for a buyback. Similarly, once you declare a dividend, it has to be paid within 30 days. It has to be transferred to a separate account within 7 days. sections 123 and 127, if you have not complied with those sections, then also you cannot go for a buyback at all. Okay. Here, suppose you make good the default or non-compliance. Suppose you file, then you can go for a buyback. Here, even if you do make good the default, still for 3 years you cannot go for buyback. Slight difference. Same section, two different categories of prohibitions. Okay. Either way, if there is any of these default or non-compliance, that company cannot go for a buyback. That is what it means. Why are your slides suddenly so zoomed in? I don't know, sir. I am using seriously, I am not a technology man. I am using my PowerPoint presentation in the normal way. So check out settings. I'm not doing anything with my settings. Maybe the slide I used was a smaller slide. What happened? I'm currently using a bigger slide for my normal. Since you wanted thing, I'm using this. Okay, friends, I will have to tender my unconditional apology to you for not explaining the numerical again. Why? Because time is running out. I have to go for debentures, which is important. Once completing debentures, if I have time, I will explain that again. That is the best thing I can do. Okay. I hope the slides are now currently okay because they are bigger slides. Yeah, see, even I have a doubt in that equation, sir. That is, the definition of debt and the definition of equity for the debt-equity ratio itself could be different. Here, in solving this problem, the assumption is that equity means only share capital and free reserves. Reserves which are not available for dividend, reserves which are notional, etc., or statutory are not considered as part of equity. On that assumption only the calculation is made. Now I still have a doubt whether those CRR, whether it is part of equity. No, actually not. But I don't know, seriously, I have my own doubts on that. Sorry, even I am having doubts. Why can't CRR be part of equity? It is not, it's available for declaring bonus shares, right? So I don't know. So which means you can always rework that equation without reducing X from 30,000. I mean, without reducing X from 10,000. You can rework it and you will get a different answer. But this problem is solved on the assumption that only free reserves are to be considered for calculating equity in this ratio of debt is to equity. There is no clarity in the section also. They are simply saying debt to equity ratio. They have not defined the word thing. But net worth is defined. Net worth is defined in the Act. For net worth, it is very clear. Share cap, paid up capital and free reserves. There they are very clear. Paid up capital and free reserves. So if you go by that definition of net worth, this is correct. Okay. There they are only including free reserves. Any reserve which is earmarked or notional or meant for any other purpose not to be included. If you want to bring CRR into equity, what you should do? Allot bonus shares and bring it in. Then it will come part of equity. So if somebody had this doubt, I accept the doubt. Even I had this doubt. Mukta ji is asking a nice question, sir. Out of some reasons, out of 100 shares, money is received against 90 shares only. Can company propose a buyback for those? Why not? See, unlike public issue where you have to get 90% of the subscription and all, here there is no such condition. Even if only one shareholder tenders, you can buy. Nothing wrong. So long as he is within the terms of the buyback, you have 1 year to complete the buyback. So you can do it. You can do it in tranches also. As and when they are offered, you can buy it. No problem. You can keep the buyback open for 1 year. So, but then again, SEBI will also be monitoring it, but it can be done. Why 90? Even only 2 shareholders are giving money, take it to that extent. Nothing wrong. There is no prohibition for that. I will complete debentures and if time permits, I'll go back to that. In fact, I would love to take up some of my assignment problems and discuss it in class, as usual, time is the greatest enemy. Maybe, suppose I'm guilty of an offense of wasting your time giving philosophical thoughts and all that. Sometimes I wander. There is also a reason. Don't worry, boss. Too much cramming also. I've never seen people clear the exam. Crammers rarely clear. There is people who keep on studying. Tell me. In the exam, buss. But people who are aram se casual, understand the principles and work out on their own, instead of depending totally on the lecture only for my inputs. Such students are 100% sure of clearing CA. People who use lectures for inputs, understanding the principles and all, and then moving on and working out problems on their own, only doubts they will come back to the teacher. Those are the people who will actually clear this exam, 100% sure. But people who depend totally on the lecturer or the lecture for their entire knowledge, CA, it's not like that. You have to do a lot of work on your own. If you have a doubt, teacher will always again guide you. But expecting teacher, give me 100%. After attending your class, I should go to that exam and pass. No, such a demand, some teachers in coaching classes falsely agree. Knowingly, they give a false confirmation that they can do it, but not possible. That is why many students attend coaching classes, they fail. Why? Because their problem is they think the entire lecture is only enough. No, sir. CA is a self-study program. CA, in those days, we never used to have coaching classes. For example, I have never attended coaching for accountancy. Never. Hey, why law? I have never attended coaching for law. Never. There was no coaching also. Only when I came to ACS, my guru came, K.S. Anantharaman. Till then, maximum K.S. Anantharaman used to take classes in the institute. I used to go and attend those classes, which will be very quick. They will only cover the broad idea and go. Then you have to do on your own. Once upon a time, when I'm talking about 90s and all, 80s and 90s, CA was a pakka self-study program. And we broke our head and we cleared the exam. I mean, I'm not saying coaching is not needed, and I'm saying over-dependence on teacher is also bad. You should tell me everything. You have taken money, no, tell me everything. Whatever my knowledge should come from only you. Such demand from a teacher, some teachers will try to make themselves popular and say, I will do it. But very difficult. So I am saying this. Basic knowledge I can give you. Then you go and work out more problems on your own. Assignments are there. But answers I will share. Then if you have a doubt, clear the exam. Okay. Numerical questions will be asked in the exam, not so numerically as I have done, but with some numbers involved and percentages. See, the core principle in buyback is 25%, 10% debt equity. Now, to that extent, yes. Since it's contained in the law, yes. One more thing. Whatever you are learning here, madam, will also be useful to you in accountancy. When you are working out problem in buyback, suddenly there won't be a different law there. It will be the same law there also. So this knowledge will be useful there also. Then in the exam, it may ask you non-numerical question, maximum, but again, it will be centering around debt equity ratio, 25%, 10%, 10% board resolution, 25% special resolution, around that. Okay. Or there are so many reasons for prohibition. So we might give you which of the following is not a reason for, which of the following is not a ground for prohibition of buyback. Or they might give you an elaborate story and say this company has done this. Company is prohibited or not prohibited, like that. So you have to be careful. That is how we will try to. So the 3-year condition will try to test you like that. So that there will be a default, it will be made up. But you'll have to measure if 3 years is over. So such cases, such numerical are definitely going to. Otherwise, how can I ask you MCQ? Yeah. See, in those days, I had the comfort of asking you a simple, straightforward question. What are the grounds on which a company can be prohibited from making a buyback? So student who had the knowledge wrote it. Good handwriting, presentation, he got marks. Now, I have to give 4. Out of that, 1 will not be a prohibitory case. So you should remember all. Only then you can rule out the one which is not there. So instead of wasting your time again and again going and doing 100 multiple choice questions, you can become strong in the subject. So that if you see the MCQ, you will know the answer by seeing it. This is the secret. Working out more and more MCQs, no. This is not IAS exam, GQ exam. Knowing the subject thoroughly, they can test you in any way they want. Multiple choice, straight answer, problem, whatever. You will be able to answer it and work out. So long as you know how the principles, nobody can catch you. This is the view of this humble idiot. Rightly or wrongly is holding this view. Kindly pardon me if I am wrong. Sorry. If you have different view, I'm very sorry. I humbly apologize. Yeah. Can company buy back preference shares before the fixed redemption period? Yeah. Such option is called a put option and call option. That is, within, say, the redemption is 5 years later, the company can have a call option by which they can say, less than that year, we will have the right to call. So, using that right, they can say, hey, if you want to give back, give, I will buy back. But remember, you can't unilaterally force him to bring within that 5-year period. You cannot say, if I ask you, have to give. No. You can say, I will have the option to ask you, call. I may call. I may say, hey, those of you who want to sell to me, I will buy it back upon the same terms as the redemption terms, whatever. But that should be there in the offer document itself. At the time of issue of the debentures, you should put the call option. Similarly, put option can also be there. After 3 years, any debenture holder can come and ask the company to buy it back. Like that. See, these are all innovative financial instruments and innovative financial strategies that you can use. Up to you. Depends on what you're doing. Yes, why not? Okay, you didn't attend coaching. Good. Institute is not coaching. Institute is not coaching. Coaching is different. Coaching is where they take money from you and make false promises. Institute is doing a service to the students. And I have attended institute classes. Okay. In those days, institute class was my only source of knowledge. I used to go. All the big shots will come and teach. All the big people will come and teach. P.B. Sambar, R. Shivakumar. I mean, those were the names. R. Bhubati, of course, our great past president, my guru, Professor K.S. Anantharaman, they will come and teach. So we will all go and wait eagerly to listen to them and pick up the knowledge. Unlike, coaching classes where, it's like a commercial transaction where they say, pay me money, I will give you knowledge. Sorry. Saraswati is too sacred. She is there in my tongue. Lakshmi is here, na, haath mein hai. Lakshmi ji haath mein hai. Saraswati ji here, jihva mein, the tongue. She is the tongue. She won't, just like that, cannot be sold. She is shared by a guru to a teacher, student in certain environments. The tuned student learns and succeeds. Untuned student still treats it as a commercial thing and says, tell me, do it. I paid, now give. Sorry, this is my view. 57-year-old man. You know my background now. I hold this view. As a student, like I was a teacher also, Zuma, give me money. I got enough and more money. What I will do with some more money. Okay, I don't want your money. What I want is your concentration, your understanding, your cooperation, so that you will not just pass the exam and sirf kaam ke liye. You will become good, highly intelligent members of my profession. That is what I want. Anyway, chalo, let's get into debentures. Last topic. We have only 25 minutes more, let us hope, but it's fairly easy. Debentures are basically loan. It is an instrument evidencing a debt. It may be secured, it may not be secured. Means it may constitute a charge on the assets of the company or not. Means the debenture may be secured on the assets or not. Okay. Debenture includes debenture stock. Means when 10 or 100 debentures are combined together and bundled for ease of trading, it is called stock. That's all. Debenture stock is when individual debentures, say 10 or 100, are bundled together and consolidated into stock. It is called debenture stock. It is done for ease of trading. When you're buying in bulk, when you're buying 1 lakh debentures, instead of buying 1 lakh debentures, if they are consolidated 1,000 debentures in 1 lot, 100 stock. Easy enough to trade. That is why no company has issued debenture stock. No company has issued stocks. No company has issued share warrant. No company will also, because there is no sense. So don't bother about it as of now. There we have explained, gone. So leave it. My guru even used to say this. It is not relevant for exam, leave it. We will all blindly follow and leave it. We won't even bother. Because he told us we will leave it. That's all. But I can't expect that from highly intelligent students like you. So I'm suggesting to you, you read it, but it's not going to come in the exam. And of course, bonds. See, once there was a time when I was teaching final exam only at a coaching institute. Before 2012, I was part of an institute, I will not name it, and I used to teach. And at one point in time, I used to, last but 2 or 3rd class, I will analyze the past 3 to 5 question papers, and then, sort of, and I used to give them 32 questions. I've done all nonsense like that. I've been a very bad boy. And so these 32 questions, out of that, about 40% of the exam question paper will come. So actually, some students will not, they'll come only for the last, they'll come for the classes initially, then they'll be disappearing. Suddenly, last 2 classes, they'll come regularly because they are not attending my lecture. They want those 32 questions because out of the 32 questions, from 40 to 45% will come. 45% will come. He cannot get a 50% or get a rank, but he can clear the exam. There are guys like that who have done it, but it's all very bad things I have done in my life. How I got those questions and all, that is a technique that we learned. We have about 5 of us, all of us got rank ultimately. We discovered that it's a predictable pattern. We predicted the pattern and we then ultimate, okay? But that is very difficult for you to do. And I doubt if it can be done now because I've been studying. There's no pattern now. Earlier there was a pattern. Now with MCQ and all, it's very difficult. Patterns cannot be done. It's very difficult, dangerous, I would say. Of course, I used it to my thing and I thought, okay, chala, enjoy, and I used to give. In fact, there are intelligent students who attended my entire lectures, then got this 32, used to get 70, 60, 70 and all, my students. Because they know, these are definitely, so they'll concentrate on this 3 days before the exam and go. And then they will get a chance. I mean, I'm revealing, unfortunately, a secret to you, which I will never do in my life again. 2012, that was it. I stopped teaching. I stopped teaching in public. Completely in 2012, I stopped teaching. Again, I'm making my entry only for our institute for ICI. Because it's my already old, it's not worth for me anymore. Okay. And again, commercial transactions. Okay. So, chalo, moving on. By issuing debentures, a company may source debt finance from the public. Debentures shall not carry voting rights at shareholders' meetings. At the meeting of the shareholders, preference or equity, debenture holders have no business, they have no voting rights. But suppose the issue involves debentures, some change in their terms and conditions, etc., they have a right and they'll have a meeting of debenture holders. It is called class meetings. Class meetings, or they are, because they are a class, right? Debenture holders are a class. They will meet and that class meeting, they have a right. They'll have vote. Voting will be proportion to value. Suppose I am IDBI, or rather IDBI bank, I have lent 3 crores. You are SBI, you have lent 7 crores. When we both come for that meeting, I will have 3 votes, you will have 7 votes. Like that, proportion. Bond is a general term for a debt instrument. In fact, only in India we call these documents or instruments debentures. The word debenture you will never find anywhere. If you go to US, you won't, the word debenture, nobody will understand what you're talking about. They only know bonds. Okay? And a bond may be issued by government or it may be issued by a company. So in India, when a company issues a bond, we call it debenture. That's what it actually means. It's a bond, basically a bond, right? When you later on in finance, either in inter or final, I don't know, you will study bond valuation. Okay, so it's a debt instrument. I am issuing debt. It's an instrument. What is the difference? When I borrow money from you and I sign a pro note, it is not an instrument. The pro note has to be kept by you and you have to come and take it from me at the end of the period. With interest, I pay you. That's all. But once I issue debenture, what happens? I'm giving you a piece of paper which you can transfer to somebody. You don't have to hold it. You don't have to come to me. If you want money, you sell it to somebody, take the money and go. He will come to me, I'll pay. That is the advantage of creating an instrument called debenture, right? Convertible debentures are debentures with an option to convert into shares. Okay? Either wholly or part at the time of redemption. You already saw this. I've told a lot about conversion, so no need for me to waste your time. FCD, PCD. Issue of convertible debentures requires special resolution. If the entire debenture is non-convertible, fully redeemable, then no need for special resolution. Board of directors can issue. Board of directors can pass a resolution and issue. But if you want to go for convertible debentures, you have to get a special resolution. If the debentures create or constitute a charge, means when some asset belonging to the company has been offered as a security, the debentures are secured. Otherwise, they are called naked or unsecured debentures. See, naked or unsecured debentures can be issued, but this topic you will have to link it with deposits. When somebody teaches you deposits, they will teach you very importantly definition of deposit. More than definition, they will give you list of matters which are not deposits. There you will find only secured debentures are not deposits. The minute you issue naked or unsecured debentures, they will become deposits. Check out when you come to deposits definition, they will give you a list of items which are not deposits. Now, one of the secured debentures, to the extent of the value of the security, not a deposit. You don't have to comply with the deposit rules. But the minute you issue naked or unsecured debentures, that will be treated as a deposit. Okay, that's what you have to do. Which is why most of the rules applicable to debentures are applicable to deposits also. Right? Like you have to create a reserve, all that is there for deposits also. Issue of secured debentures is governed by Rule 18. Secured debentures shall be redeemed within 10 years from the date of issue. Exceptions are infrastructure as usual, which can go up to 30 years. Similar to preference shares here also. We already saw this: secured, unsecured, convertible, mandatorily or optionally, partially or fully non-convertible. So sometimes conversion can be optional. You can tell him at the end of 3 years or at the end of 5 years, you have the option. You can either convert to equity or I'll give you the money back. Redeem. Option. He has to exercise the option before a certain date. Then, depending on what he's doing, he'll get it. If I'm going to have a conversion option, I should predict a rate at which I will convert. I should be able to get my valuation right for the next 4 years and say, 5 years later, I will convert. This is the value. Or you can give a formula also in that. You can say, whatever may be the market value, plus or minus, we will convert. Agreed. If it is a listed company. But that rule should be clearly mentioned here. On the basis of redeemability, redeemable and irredeemable. Okay, you cannot issue irredeemable preference shares, but there is no prohibition on issuing irredeemable debentures. Technically, you can. Very important, debenture redemption reserve, DRR. Okay. The company shall create a DRR out of profits available for payment of dividend. Debenture redemption reserve. See, I will give a simple example you will easily understand. I borrowed money from my uncle. Uncle says you can repay, Srikanth, pay me after 7 years, 5 years. I borrowed 5 lakhs. Small, poor man, 5 lakh, big amount for me. So I'm earning as a chartered accountant something. Every year I have. So I know 5 years later I have to give back 5 lakh to this man. Correct. So now I'm having some money. Now what I will do? Every year I will keep 1 lakh as a reserve. I'm giving my example. Don't confuse. In the act it is different, but example. So out of my profit, out of my income for a particular year, I will take out everything, but I will leave 1 lakh separately and I will, in my balance sheet, I'll show it separately 1 lakh so that I will know to the extent of 1 lakh, I cannot touch my bank. To the extent of 1 lakh, I should not touch my bank balance. Why? Because I have to use this money for repaying my uncle 5 years later. So if I keep on doing it for 5 years, at the end of the 5th year, I'll be having 5 lakhs. Call my uncle, Uncle Ji, please take your money. He will also happy. I have been financially prudent. Instead of enjoying my life, for 5 years, going everywhere, drinking, enjoying, then money is wasted. Suddenly 5 years later, where is the money? They will say, Srikanth, you earned so much money. What did you do? I'm sorry, uncle, I'm not able to repay. Like that, why should I talk? So prudent accountant, what he will do, as and when they earn a profit, out of that profit, they'll create a reserve. And DRR, once created in the balance sheet, shall be utilized only for redemption of debentures. If the finance guy is even smarter than this, what he will do, instead of keeping that 1 lakh in my SB account or current account, I will take it out of the SB account and invest it in mutual funds. In fact, I might even invest a lesser amount than 1 lakh in mutual fund because the mutual fund will earn return. So that at the end of the 5th year, along with the return of the mutual fund, I will have 5 lakhs to repay my uncle. This is financial prudence. The law only makes it compulsory. But even without the provision for DRR, if you are a smart CFO, you should insist to your board of directors that, hey, let's every year set out some money for repayment, redemption of the debenture. So that at the end of 5 years, I don't have to struggle, run around for money or borrow from somebody to repay Peter to pay Paul. No. Okay. So DRR is nothing but financial prudence. DRR shall be utilized only for redemption of debentures. DRR shall be created in respect of non-convertible portion of the debenture. So to the extent of convertible portion, I don't have to create DRR. Yeah, I'm not going to give him money now. I'm going to give him shares. So to that extent, no need for DRR. Only non-convertible portion. So, but again, you'll see it's all watered down because all these companies need not have DRR now. All India financial institution banks going for a public issue of debentures, not required. Private placement, not required. NBFCs, housing finance companies, and other listed companies, not required. Why? Because when they go for public issue, they are monitored by SEBI and RBI and all. So that is why here they are released under the companies that they are released. In private placement also, they need not. Unlisted companies other than NBFCs, housing finance companies, public issue. Friends, when they go for public issue, they become listed company, boss. So this concept is not applicable. But unlisted companies going for private placement, every year, they have to create, at any time, they should have 10% of the value of outstanding debentures should be present in DRR. Should be present in DRR. It's a very small amount. 10% of the value of outstanding debentures. That's all. The idea is, suppose there is a sudden rush, you have to pay. So it's like a cash reserve, that banks are keeping. They wanted to keep 10% of the value of outstanding debentures as DRR. Only for unlisted companies other than NBFCs, housing finance companies. Right? Similarly, in addition to DRR, every company liable to do so shall, on or before the 30th day of April in each year, invest or deposit not less than 15% of the amount of its debentures maturing during the year, ending on 31st day of March next following in any one or more of the following methods. So what you should do, on 31st of March, you'll have a balance sheet, right? On that 31st March balance sheet, you should find out next 31st March, 31st day of March, next following, how much debenture will I redeem? What will be the amount of debentures redeemed? And that I should, to that extent of that amount, only those debentures maturing during the year, not all the debentures, only those debentures which will be redeemed before the 31st of March next following, on or before. Okay, then I should create a sort of investment of not less than 15% of this amount. This amount cannot be put in anything risky. It should be deposited only with scheduled banks. Unencumbered government securities means unencumbered means not having any loan. They should not be offered as a security for any loan, no pledge. Unencumbered government securities. Unencumbered securities and bonds specified in the Indian Trust Act. See, the Indian Trust Act gives a list of investments which a trustee can invest in a trust fund. Basically, low risk, low return, safe. Unencumbered means that the above investment shall not be offered as security for any loan. The above deposit should use only for the redemption of debentures. The amount should not fall below 15%. So every year you have time till 30th of April. Before that, you have to ensure that you are topped up. So all the debentures ready to be redeemed during this period, 15% should be kept in the bonds of all these amounts. Here's a test question. You can try to answer it. Okay, I'll take up your questions at the end. So, ABC Limited is an unlisted public company. It issued partly convertible debentures on private placement basis. So it has to create a DRR. First of all, 1 lakh into 100. Out of rupees 100, rupees 75 is convertible into shares and 25 redeemable. So on the convertible portion, I need not create DRR. Only on the non-convertible portion, 25 lakhs. On that 10%, I have to create a DRR. What is that? 2,50,000. Similarly, these debentures are redeemable on 30th September 2021. So for the financial year 21-22, since during that year, ending on 31st March, this will be redeemed, 30th September, the 25 lakhs, on that 15%, I have to, that will come to 3,75,000. That is 15% of 25 lakhs, which will be maturing in that. The remaining 75 is convertible. I don't have to bother. So 2,50,000 is the DRR. 3,75,000 is the amount to be deposited. That is 15% of the deposits maturing during the year. Means the entire 25 lakhs is maturing on or before 30th September, which is falling within 31st March 22. Therefore, on or before 30th April 21, I should transfer, I should deposit 3,75,000, 25 lakhs into 15% in the specified investments, right? As a loan now. So the terms are such that on the date of redemption, I'm asking him, you want money or you want share? So if it has a conversion option, he can choose. If it is compulsorily convertible, no question, I have to give him share. But it can all happen only on the date of redemption, boss. See, on the date of redemption, I'm giving him two options, money or my shares. Depending on how popular my shares are, he can choose. If he feels my company share is useless, then he will say, please give me my money, I will go. But if it is compulsorily convertible, then even he can't talk. It will be converted into my equity shares. So, on the date of redemption, see, if it is convertible partly I will pay him, I will redeem. Partly I will convert. On the non-convertible portion, no question of conversion. He will be paid the money. On the date of redemption, instead of giving him money, I will allot him shares. So, non-convertible portion, no problem. Only convertible portion will be there. Partly convertible debentures. Fully convertible debentures, then the entire amount will be converted into equity on the date fixed. Okay, which will be again, see, 5-year debentures, boss. I need to use the money for 5 years now as a loan. I have to enjoy that now. On the 5th year end only, I have to repay. Instead of repaying, I'm going to convert it into equity shares. When 10%, you are not listening to the lecture at all. You are not looking at the slides at all. See, you have to create a debenture redemption reserve. That reserve is 10% of the value of outstanding debentures on that day. On 31st March, whatever is outstanding, convertible portion alone, non-convertible portion alone, you have to create 10% debenture redemption reserve. Now, every year you have to see what is the amount of debentures to be redeemed on 31st day of March next following, on or before, during that period. And to the extent of 15% of those debentures that are maturing during the year, you have to deposit it that in cash, in money, you should keep it. 15% should be kept in a deposit. That is debenture deposit. Okay. This is, so 15% deposits, 10% reserve. 10% reserve applicable only to unlisted companies other than, similarly, debenture deposit also applicable only to unlisted companies. That is why this problem has been given to help you guys. So, when I issue debentures, I need somebody to protect the debenture holders. This person is called the debenture trustee. They will be appointed. Usually, the debenture will be issued through a merchant banker or a banker, investment banker. That investment banker himself will become the debenture trustee sometimes, or some responsible citizens can be appointed, leading chartered accountant, advocate can become debenture trustee. Their job is to protect the interest of the debenture holders, redress their grievance. The debenture trustee deed should not contain any clause exempting a debenture trustee from his duties or agreeing to indemnify any loss on account of breach of duty. So you cannot say you be debenture trustee. If something goes wrong also, no problem. If he is failing in his duty, he is liable to the debenture holders, and that cannot be indemnified by the company. Right? So, but some liability of debenture trustees may be exempted by an agreement agreed to by a majority of the debenture holders, holding 3/4 in value. See, sometimes what could happen, an investment banker would say, I will be the debenture trustee, but sorry, I will not be liable, exempted and all. Then, once the debentures are issued, when we appoint the debenture trustee, at that time the debenture holders holding 3/4 in value, who are majority in number, should agree, okay, we won't sue you in case there is any breach. If they decide, no problem. But the trustee deed cannot contain any clause exempting a debenture trustee. It is the duty of a company to pay interest and redeem debentures. If the debenture trustees come to conclusion that the assets of the company are insufficient or are likely to become insufficient to discharge the principal amount as and when it becomes due. So if they feel that the company is going to become insolvent, the debenture trustees will file a petition before the tribunal. Then the tribunal will go through it and order or impose restrictions on incurring further liabilities. Thereafter, tribunal will monitor this company. This is the role of a debenture trustee, to keep monitoring the company. In case they feel there's a chance that assets will be eroded, then they have to immediately file a petition to the tribunal. And tribunal, after going through the figures, and they will even consult a chartered accountant to give an opinion, they might say, yes, this company is financially unsafe. No more liabilities. Start repaying the existing debentures first. Or be sure that you have enough assets to repay. So, this is one beautiful provision to protect the debenture holders. Similarly, where there is a failure to redeem debentures on maturity or to pay interest, the debenture trustees can make an application to the tribunal. Either all of or any of the debenture holders can go, or the debenture trustee can go. And the tribunal may by order direct the company to redeem the debentures forthwith. That's all. Once the tribunal passes the order, that order can be executed as a decree. If you have any property of the company, you can attach it and take the money. Okay. So this is again it's a protection for the debenture holders. Any contract with the company to take up and pay for any debentures of the company may be enforced by a decree for specific performance. Okay. That is, suppose Mr. A has entered into a contract with the company to take up and pay for debentures. So, there's an agreement between the company and Mr. A that he will apply and take debentures. Later on, he says, no, I'm not going to take the debentures. Then, you can go to court and you can file a suit for specific performance. That is, you can insist that, see, when you go to court and file a case, you should have a prayer. If I have lent money to Mr. X and X is not repaying, I go to court, my suit, the prayer will be, he should repay my money with the interest, also additional interest for delay. These are my prayers. Like that, in this case, when I file a suit, the company will pray that he has agreed to take up and pay for debentures. Force him to do it, make him do it. That is called specific performance. So the court will pass an order directing that person to take up and pay for the debentures. So he cannot come to the court and say, sorry, I cannot take up the debentures. Maybe compensation I'll pay for their, some amount of compensation I'll pay. No. I want specific performance. See, the ultimate example of specific performance was Shylock. See, Antonio said, sorry, I will give you interest. My money has come, take it. He said, no, you didn't pay on the due date. Therefore, you owe me a pound of flesh. Specific performance was demanded by Shylock. Of course, you know what happened when specific performance is asked. Sometimes it becomes dangerous. But here you can insist. Specific performance means do what you promised to do. You promised to take up and pay, do it. If there is a default in compliance with 71, right? Every officer who is in default, fine of 2 lakhs up to 5 lakhs have been able to complete the topic within the time given. Let us now see the questions and then close. I would love to solve more questions, time permitting, madam. No guarantees, no promises are made. Time is not there, I can't. I have to cover the topic or I have to solve problems. So, as students, you would love to have more problems to be solved, but I have to cover the topic also, right? Let me see. Okay. Does buyback of shares include all kinds of shares? Equally preference bonus. Does buyback of shares all kind of shares, equity, preference bonus? Sir, buyback only for equity. Both DVR and normal. That's another question. I will answer it now. Both DVR and normal. Preference share, you already got redemption. Right? Also, I don't understand. Once bonus shares and right shares are issued, they are not separate, yeah. They become part of the equity base. Once they issue bonus shares, it is not as if separately those bonus shares will be coming. It will become part of my paid up equity capital. Right shares also will become part of my paid up equity capital. Available for buyback. Okay. So I think there's a basic confusion, Muktaji, that your bonus and rights are showing separately. They have some separate life. No. Once at the time of issue only, it is bonus, rights and all. Once issued and allotted, it becomes part of the paid up equity share capital. That's all. And as such, it can be bought back. Okay. I hope this clarity has come. So don't confuse. Preference shares redemption is there. So why buyback? You got redemption provision. Go through that. DVR can also be bought back. Good. Debenture is a bond. Bond is the common name. Debenture in India, we use debenture. When a company issues a bond, in India, we call it debentures. See, you go the world over, you will never, if you say debenture, they look at you like a strange animal. The word, it's an old British term, even British are not using it anymore. Even they call it bond. US, 100% we call it bond. Corporate bonds, government bonds, or treasury bonds. That's all. Both are bonds. Both are treated similarly. They have common features, like they have the coupon interest, the issue price, the coupon interest, the redemption price, terms of issue, maturity period. That's all. Then you can calculate the yield to maturity. Same rules which are applicable to bonds. In India, when you say bond, only treasury bond they will say. They think only treasury bond. No. Immediately don't correct me and say, it is there in such a... But actively, volumes are not there for it to become attractive. But if that happens, only then our market will be mature market. Till then, I assure you, we are not we are still totally dependent on equity markets. There should be a vibrant debt market also, where we can buy and sell bonds, like company corporate bonds, debentures. So, I have answered some of these questions. If they are convertible, then the shares issued in return or at face value, it can be at a premium. See, at the time of issue of the debenture or preference share, I will have to determine at what price it will be converted. Not necessarily face value. It could be at a premium also. Or I could give a formula which says we will take the average price of the share in the market for the last 21 days or 3 months. And that will be taken a weighted average price. That is price into trading volume, total divided by total trading volume for the last so many days. Like that, you can give a formula for arriving at the value. Or you can say the conversion will be done at a value to be at the fair market value to be determined by the registered valuer at that time. So at that time, you have to do a fair market valuation and do it. Whatever. But you can do it above face value also, premium also. Yes, it can be done. Total 25% kept aside. No. 10% reserve is in the balance sheet. Out of that 10 plus another 5, 15%. So technically, totally 15%. Okay, it's not 25. Totally 15% you can say. 10% I create a reserve. Again, remember that 10% is created on the total debenture amount due on 31st March. Whereas this 15% is only for the debentures maturing during the next financial year. So alag hai. Don't confuse. Don't try to combine them and create one limit. The alag limits. Don't confuse. Okay. Okay. Unencumbered securities, we have already given you a definition. Unencumbered means that the above investment shall not be offered as security. Means I put the money in government bonds and then I take that government bond and give it to the bank and take a loan. No, that should be unencumbered. No loan should be taken against the security of these items. For bonds, what they create as we create, no, I am not aware. See, in India, there is no. See, if a corporate is issuing a debt instrument and calling it a bond, still it is a debenture. That is why debenture definition includes bond. Debenture includes bond. So the minute you say bond, also it's a debenture. And section 71 will apply to you. Everything. Government can declare. Corporate, if it's issuing a bond, it is a debenture and rules apply. That's why they don't use the word bond. They prefer to use the word debenture because in India, people know debenture better than bond. But I wish we would change it to bond and start calling it bond. Not James Bond. Huh? So debentures which are not secured and fully redeemable contains any. See, if debentures are not secured, as you will understand it better when you come to deposits. If the debentures are not fully secured, then and they are fully redeemable, they are make it 100 rupees per share. Why not? Consolidate. You go back to your 63 and see, there you'll see. Subdivide or consolidate. Yes, why not? You can consolidate. You can consolidate, say face value is 10 rupees. You can consolidate 2 and make it 20 rupees per share. 2 shares can be combined into 1. It's your choice. But normally, if you're going to have your shares listed on a stock exchange, they may not permit you to do this. They have a rule on face value. So 10, 1, like that. But you can always make an exception, justify why you are doing it and do it. Fantastic. Share capital and debentures is possibly a very, very important and interesting topic. I will be uploading the PDF file. Also, I will be uploading this assignment for this topic. And I will also be uploading the answers for all the assignments. Then, inshallah, if time permits, I will try to work out some of these practical MCQ type of questions. Let's create some time and do it. Okay. Even in a later class, if I am having some time, 20-30 minutes, I will do it. In the meantime, if you have any doubts on the assignments, do feel free to send me a query on the query pad. Only that question I'll try to answer in that class. Okay, something like that. Thank you for a wonderful participation. Thank you for being such great students. I wish you all the very best and pray to God that you should all become members of the Institute of Chartered Accountants of India and successful in your life. Thank you. Bye. Yes, sir. Concluded.